Good afternoon, my name's Lisa Sanders and I'd like to welcome you to this afternoon's webinar on how to finance your future strategy. The topics we'll be discussing today will be centred around avoiding common mistakes when taking out a home loan, especially when you're a property investor. The second thing that we'll be discussing is how you can increase your cash flow. I'm going to run through some tips and tricks that will help you to improve the cash that you have on hand now, but also the cash that you're going to have well into the future. I need to firstly cover our disclaimer today. The most important thing to note with this webinar is it's intended for information only and that you should seek the correct amount of professional advice regarding your own personal situation before acting. Three things we're going to discuss today. The three topics will be controlling your equity, maximising your cash flow and protecting your security. When we're talking about home loans with property investing, I'm going to talk about your equity, and when I refer to equity, if we want to give it a metaphor, equity to your portfolio is the same as oxygen to your body. So understanding that, you can understand how important it is that you want to be able to control that equity and make sure that you are the one that is in control. One of the most misunderstood things, but certainly one of the simplest things that you can do to control your equity is to choose the right repayment plan. Now there's two choices. You can choose principal interest and interest only, and a lot of people get confused as to, well, firstly, do they ever have a choice? Is it your choice or is it the lender's? And I will say that in each and every case, I can only think of a very few small situations where you would be forced to choose principal and interest. But what people don't understand firstly is that it is their choice whether they want to pay principal and interest or interest only. But secondly, something that's super important is people think that you choose interest only for investments and principal interest on your owner-occupied debt. And that's where it gets a little bit confusing, because what a lot of people don't realise is they can choose to make the commitment to the lender interest only repayments, but that they can still choose to repay that principal debt. And that's very, very powerful, especially when you're controlling your equity, because you can make the commitment to only make interest-only payments, but you can pay additional payments, i.e. you can pay the principal down in full, but because you've chosen the commitment of interest-only, you can redraw any of that money at any time over the term of the loan. So that is very, very powerful, and what most people don't realise is when they choose principal and interest, with each and every repayment, they're giving back a portion of their equity back to the lender. And if you have a look at this particular slide here, you can have a look at the principal and interest versus the interest only. You can see obviously the impact of that over time and how much equity your lender would be controlling with each and every year that passes. So it's important that you understand that with each and every loan and every time you borrow, you should be doing so on an interest only. However, on your owner-occupied property or any bad debt, you should be choosing to, as often as possible, repay the maximum amount that you can. When you have a look and I talk about principal and interest versus interest only, and it's your commitment to the lender, that is how much you have agreed to repay weekly and or monthly. And if you have a look at it, on a $450,000 loan, when you're looking at principal and interest, your commitment is $656. Whereas if you take a look at interest only, your commitment to the lender per week is only $562. So you've got a $93 buffer in the situation over the term of that mortgage where your commitment is less but you could choose to repay more. So that's a very important point for people to note, is their commitment. They don't have the same commitment, but they can choose to make additional repayments should they wish to. I have a lot of other people that talk to me and say, well, what does it matter whether or not I can control my equity? I've chosen principal and interest. It means it's a forced savings plan. Well, some people obviously need to be on a forced savings plan. However, I'm always one to say, well, the equity should be yours and you should be controlling it. And if you can access that equity, what could you do with it? And if you take a look at this particular graph, or this particular slide, it will show you $50,000 worth of equity can allow you to borrow at a 90% LVR, leverage that $50,000 and purchase a property worth $333,000, which to me is excellent leverage that you can get. If you've got more equity, obviously it gets, that amount gets higher and higher. And there is still property, very good property in Australia that you can purchase for around the $333,000. More so not the $50,000, and what could you leverage it into? So you could leverage $50,000 to a property worth $333,000. But I think the most important thing is to say, well, if you had the $50,000, what's the opportunity cost? And I think it's the carrot and stick. The carrot is you could take $50,000 and you could utilise that and go and buy a property worth $333,000, and you could leverage it. But then the stick is, if you don't leverage that $50,000, what's the opportunity cost to you? And I think this is what gets most people, is the opportunity cost is about $9 an hour, $232 a day, a week. You have a look at a month, or $85,000 per annum is the opportunity cost of actually, if you choose to sit on the $50,000 or you don't actually look to invest that, the opportunity cost to you can be huge if you have a look at that. Controlling your cash flow, or maximising your cash flow, sorry. This is obviously near and dear to most of our hearts. I think surely most of you listening to this would be out there saying, I'm sick of hearing that the cost of living is rising. I'm sick of the fact that I've got more week than I've got money. I'm sick of the fact that I feel comfortable with my assets, but I'm struggling to make ends meet week to week. A bill comes in and there's a panic on how you're going to find the cash to pay unexpected bills. So I think all of us would like to take a good look at how we can actually income the unexpected expenses that come up, but also to have some extra cash there to be able to use it to invest and create wealth for ourselves. And here's a few tips that I have obviously put together over time of dealing with our clients on very, very simply, how can you free up some of your cash flow? How can you have more cash in your pocket? How do you get it to the stage where you've got more cash than you've got week? First thing is to have a cash flow plan. Now, saying the word budget can be a very dirty word to people, and most people will avoid it like the plague, but to have a plan, or if you don't have a plan, you plan to fail. Everyone obviously understands the concept of the fact that if you fail to plan, you plan to fail. I think it's very, very important to understand how much money have you got coming in each week, what are your expenses each week, and what money can you put aside to invest. So if you haven't got a cash flow plan and you'd like some assistance, please get in touch with us or do some research on the internet. There's some excellent sites out there that can help you not only to give you a list of obvious expenses, but to help you to be able to put that in place. Cancel any unnecessary memberships and rental agreements. We all have a bit of a chuckle about this, but how many of us have had gym memberships that have lasted forever when we promise ourselves that we're going to, we keep paying it each month on the vain hope that we are going to finally get to the gym. Or you've signed up for things like Foxtel, Foxtel and Allstar, sorry, the pay TV. And I always say that it was an interesting situation when I had to move house a couple of years ago, and I was paying about $140 a month for pay TV. And when I moved into a brand new development, and they obviously didn't have the facilities set up for us to be able to get the pay TV in the new property that we were in. And it took them a few months before we were actually able to do that, and it was quite interesting because what I found was in that period of time, the months that I'd gone without it, I found out that I actually really didn't need it, and then when I was able to get it again, I was begrudgingly, or I certainly turned around and thought, well, I don't think that I want to pay an extra $100 a month in order to have something that I'm obviously managing without. So sometimes it's good to take a step back, cancel them, see how much you miss them. Maybe you can reduce the amount you're paying, but certainly take a look at all of your memberships and all of your monthly agreements, all of the direct debits that come out of your bank accounts, and have a solid look as to whether, do I really need it? Is it a necessity? Am I using it? That's probably the most important thing, is we tend to have these things disappear out of our bank accounts each week and each month, but we really don't take a good look at whether or not we are actually getting the service that we're paying for. Ensure you have the right insurance structure. We talk to a lot of people who are paying unnecessary insurances, and they actually don't have the level of cover that they think that they do, or they have their insurance in completely the wrong structure. You know, some examples of this, and again, I'm not using this as advice, but I know a lot of people that are in their 30s or 40s that have got income protection within their super, and should they actually ever need that, the cover's paid to the super and to their super, and because they haven't met the release, obviously those funds won't be available when they most need it. I've got other people that are paying for unnecessary insurances where the cover's not going to be sufficient for what they need. So I think it's very important that you have a look. 95% of Australians, sadly, are underinsured. Their families aren't protected. They're not protected. And what we see is a lot of people take out debt, get mortgages, they go and buy investment properties and get debt, and yet they haven't insured the most important thing, and that is their income, to ensure that they can actually repay that debt. So it's super important that not only do you have the correct amount of cover, but that you understand, you do the reviews regularly to make sure that the insurance premiums that you're paying for are in the right structure, that they're being paid for correctly, and that they're going to cover you should you need it. So